Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Tuesday, November 7th, 2023. It is 2:14 p.m. as I'm starting the video, and we're going to focus mainly on the stock and bond markets. Those two right now are extremely tied at the hip. So I just wanted to talk on that. Time permitting, I'll get to some of the other trade ideas. And gold just hit the next price target today and bounced off that. And I still don't have a very strong opinion on natural gas. I've given some periodic updates there. It's bouncing around a range, needs to break out. But let's focus on the markets on this one. And time permitting, I'll include a few of the other things, so to speak. But right now, the single most important thing is, in my opinion, are interest rates. I would direct you, if you somehow missed it, this is probably the most important post I put out in a while. That kind of shares my thoughts. When was this? From just the other day. Let's see, the date it dated November 3rd. So, and on that, down at the bottom, I've written more. You know me. My front page posts are usually trade updates or whatever, just a couple sentences, a paragraph or two on a trade idea or the markets or an outlook. But this right here, if you haven't seen it, I recommend you take a look at it. It pretty much sums up what's going on now. And again, this is something I've actually been talking on for months before it even happened. And that was, again, the prediction that rates could go up and break out the new highs, and quite likely would. And then at that point, the market would become hypersensitive. And that is 110% what has happened. If you just compare, as I pointed out here, go to any chart of treasury yields. Go to, the 10-year is typically the benchmark. You can go to the 10-year, you can go to the 30-year. You can even look at the 5-year. They tend to move together. But 10-year is the go-to one. And so that's 100% what took the market down into the recent lows, with the rates breaking out the new highs. And again, you can watch. I keep multiple charts up at all times on multiple monitors, streaming charts, and you can see it's almost tick by tick. And so that's going to, in my opinion, continue to be the case. And so for the most part, as I said in this post, here's a dilemma, on trying to time the next leg down, is that at this point in time, it appears that yields down and the stock market down are mutually exclusive, meaning it's not going to happen. As long as yields continue to fall, interest rates drop, the market's going to rally. Now, that's not going to be indefinite. As I said in here, I think there'll be a handoff. If you read down here at the bottom, it won't be a one-day event, more of a process where at some point in the foreseeable future, we'll probably begin to see weakness in stocks due to economic concerns, increased worries about a recession, and therefore a decline in corporate earnings. That, I think, is coming. And then at some point you can and will see that disconnect. So in other words, the easiest way to say it is right now, stocks and bonds, bond prices, which again, I know this gets confusing to some. Interest rates, when I talk about yields or rates, remember when I say yields down, that means bond prices up. Bonds and interest rates and bonds always move inversely to one another. Falling rates causes bond prices to go up and vice versa. Okay, so again, we've seen yields falling recently, which means bonds have been rallying. That's why CB, ZN, TLT, that was, I stated that as actually it's my, pretty much my biggest position by far right now. I just don't have, and again, you can't get overly bearish on the market right now unless we can make a case that yields are going to come back in. So anyways, that I would direct you to that post, and then let's just jump into the charts and see where we're at, and then we will get to that. We'll do a somewhat of a deep dive on treasury yields. Probably the most significant development today, we've seen QQQ broke out of that primary downtrend line. Remember, this is the downtrend line from the mid-July highs. Is very significant, very well defined. We've had multiple shorting ops off there. And so that's been taken out. And what it also did is it took out the previous high. See, if you turn off all the lines here, you now have, kind of brings the downtrend into question, because a downtrend in its purest form is a security making lower lows and lower highs, which it had been making. But now all of a sudden, this high has been taken out, not by a whole lot. And again, I got this out to you this morning. That's one board I have. On this one, I have, you can't even see it. I have different boards on the 60-minute, or on all my charts really, on this program here. That's 374. I identified it on another board this morning as 372 right there. We're still a hair above that. And you know what? Technically speaking, I might have misspoke. We didn't, we're talking hairs here really, and you shouldn't have to zoom in so much, but we didn't take out that high yet. I'm talking this previous high. We're testing it right now. And now that is resistance, because that's the reaction point. So as you can see, as I put my crosshairs up, it's really closer to 374. Again, I had, this board here that I had at 372, and that's the one I picked this morning, just because that's the one I've been showing you lately with the pullback targets. And so, I still suspect that we are going to fail that breakout, as I said this morning, and go on and hit at least these near-term pullback targets, 1, 2, and 3, and that's why I use that board. And then if we do, that's going to also have a couple other implications. Number one, it's going to mean that we failed at that previous high, and we didn't take it out. Keeps the downtrend alive, at least for that point in time. And we also have the potential to fail the breakout right here. So watch that. Remember, it's been a very overbought run, and I think on the other board I had the divergence. I want to just show you we do have negative divergence, and it's not very big, but sometimes it doesn't take a lot. I'm talking the scope of this divergence. You can see here it's not a very big divergent high. It's clear negative divergence. Indicators making lower highs, and the price is making higher highs right here. But it's right in line right here with this divergence right there from that previous high right here. There was our divergent high. So anyways, wanted to point that out. Again, there's a lot of upside momentum, and for this to be anything more than just a back test of the trend line, which would be bullish if we back test and then run up, or just a minor pullback and then we come on up there, to get anything much more than that. And there certainly could be, and I will add additional targets if I think that's going to be the likely case. We've got to see, I have to be able to make a case to close out those treasury bond positions, those swing trend positions, or at least game a quick pullback there. And I'm going to get to that in 1 second. So that's where we stand today right now in QQQ. Technically, we have broken out above the trend line. There's only an hour and 40 minutes left in the trading day, so it would take one heck of a reversal. It's possible, a late day dump to get back below there, and that would be very bearish as well. So bottom line, I'm just trying to impress that as of now, and I always say this, a breakout is a breakout until and unless it fails. And right now it hasn't failed. A lot of momentum. There's no evidence that it's going to fail. But if it does fail, and not just a little marginally, measly poke down below there, a solid move back down below, then that will be, at that moment, a false breakout, aka bull trap. As of now, it's just a regular breakout. Got it? So bullish right now, bearish if it fails. Simple, right? Now let's look at SPY. SPY is at, or I have different boards there as well. Let me tighten this one up. What are we on? We're on the daily here. I need to fix my lines here. They're a little askew. All right, we have right there. So here's our primary trend line. Let me make it a little thicker so it stands out. We'll do it this way. Thicken it up, maybe color it up, pick purple. So you can see that SPY is still below its comparable downtrend line off the highs. We have distinct reactions, 1, 2, 3 clean reactions. That helps to validate it. And we're also at a level here I've had for a long time. This is a what I call a resistance zone. If you zoom in close, you can see the last several, we had about a week of trading here at that level that the markets or SPY couldn't get through, and we're there now. So as I just showed you, QQQ just broke above resistance. SPY is at resistance with an even as significant, if not more significant, downtrend line just above. So another way for me to spin this, most of the meat on this initial leg up, if not 100% of it, has already been sheared off the bone. So, to buy right here, right now, even though the QQQ is broken out, is just not objective. In fact, here, let me show you one other sector, one of the most important sectors in my opinion, or subsector of tech, SOX, and it just hit our bounce target. Remember, SOX is one of the ones I went long here recently, posted as a long trade for bounce. We were, short. We had T1 hit here on the downside, and we T1, T2 hit here, in which case, I said the odds are good for bounce, and we gave you a bounce target, and that was 2 targets on stocks. Yeah, I'm just pulling up the last update here on the site. That was it, November 3rd, approaching. That was the the long entry there, cover shorts, because that's not a little minor bounce. That's a pretty decent bounce. 477.48 in the intersecting downtrend line. Again, that was back from October 25th, and then we went just a hair lower. This was the update the other day I gave you on the 3rd here. We're coming up to it, 477.48. That was then. And now we are there, 477.48 and the downtrend line. So if you took that one, it is a great time, in my opinion, to book profits if you haven't done so already. Yeah, it's about a 7% move in just since not even a week and a half, not even 2 weeks. Again, when it entered a day or two early there, but hardly. We're talking, went through about 2% downside to gain, and I'm measuring from the entry point. That's a 7.5% upside, significant resistance. So to recap, I just showed you QQQ is broken out, but the S&P 500, which is more indicative of the whole market, and the semiconductors are at resistance. And they could break out as well, but unlikely before at least a reaction. I define reaction. Reaction is one of two things. When a stock or security is going up, a reaction can come in the form of a consolidation, which is a reaction in time, or a pullback, which is a reaction in price, or any combination thereof. So I would say the odds are pretty good at best. The S&P, like I said, I showed you, has a little more upside. Maybe stocks will want to pop, but stocks also has some pretty good resistance. So the breakout on QQQ, I suspect, is at best going to pull back and back test soon. And then and the S&P, if it does pop up a little more, like I said, the S&P, the semis are hitting resistance. And let me get to bonds, because that's really what it's all about. So again, that post earlier this week, last week, regarding the fact that, I do think in the coming months, plus stocks are going a lot lower. However, until we see bonds start to, interest rates start to tick back up and give some worries, or like I said, we start to see, and it'll be a handoff process, not an all or none, single event where you see the market maybe shift to the disconnect. Again, you can see it here. Sometimes I say these things, and instead of taking on faith, you can look and see this is TLT. And so there it is. You can see the unmistakable correlation. Remember, they do not move in the same percentage terms. As I mentioned, when I gave you the setup, we were right in there, right at the lows. There was our breakout and back test. And so we just hit T2 recently, pulled back. I'm referring to the red and green, the candlesticks. And you can see this is the stock market following. Remember, when TLT is going down, rates are going up. There was a pretty sharp leg down. The stock market followed. Yields bottomed right there, so bonds rallied, and so did the stock market. So again, look at the turns on this, and it's and no one can argue this is a very, very tight correlation. Again, at some point, going forward, I suspect it will probably disconnect due to the reasons I said in that post. More of a flight to safety reason for buying bonds versus economic growth expectations. So, and the Fed right now is they're, Powell speaks tomorrow. Powell is insignificant right now. He's almost a lame duck, if you will. They held rates tight as we knew they would. He said he's, still open to another rate hike, but the market dismissed him. They're pricing in, the next move will be a rate cut. And so, we all know Powell will, the Fed will always be, they're going to be behind the curve, and they're also going to change their tune depending on what's going on. But I just wanted to say this is what's happening now. Again, you can see bonds rallying, but as I said in there with this trade, and I always do on treasuries, because of their lower volatility. In a good day, treasuries are going to go up 1-2%. Today's a 2%, and that's an extreme, pretty much an extreme in TLT. But I always said on this trade, in the previous ones, you want to at least double. I usually do about a 2.0 beta adjusted position size. That means twice what you'd put into the equity markets. Therefore, so we've had a 7% rally or profit on TLT to T1, which is really comparable to a 14%. If let's just say you took TLT to hedge a short position on QQQ or SPY. Well, that's how that works. You would have had twice as much in TLT as you'd have into SPY or QQQ, and therefore should have more than offset any losses or give back on those shorts. Okay, quick look at the economic calendar. Relatively light this week. Remember, this can be accessed under the Resources tab on the top menu right side of the chart, and then go into Tools of the Trade. There's Powell speaking tomorrow. That's why they have it in red. But again, I don't think we're going to hear anything out of his mouth that we haven't already heard. And the market, again, the market's already pricing it and has been what Powell's going to do before he does it. So there's that. And then, if you're trading crude oil, I don't have a very strong opinion on it right now. It's probably going to set up for a bounce soon. And it's been falling, and that's also net bullish for equities. So just keep in mind, use this counter if you do trade natural gas. Every Thursday you get the inventory reports, crude and natural gas. Crude on Wednesday, natural gas on Thursday. But this is the one I've said I'm watching most closely, because I think we're going forward from here, we start to see that transition where the market is rallying. They're giddy over falling rates. Again, hypersensitive right now. However, it will soon, or increasingly, I should say, turn its focus towards what's going on in the economy. So if jobless claims come in hot, consensus is for initial claims of 220,000 with a consensus of 210 to 225. Anything much above consensus, especially the top end of the range, what that's going to show is, we got what we want. Powell's slowing. He's not going to raise rates anymore, but guess what? The job market goes, that's the the biggest pillar of the economy, consumer spending, which is over two thirds of GDP. And so the consumer tucks in. You have CEOs like Target CEO already telling you consumers are shifting and tightening their belt. But again, this is what the market will react to. So we'll watch this. And again, I don't have a very strong opinion on this right now. I think we will continue over time to see these numbers tick up. I think the inflection point is probably in, but only, what matters is when the institutions see it. They're going off this data, and that's when they will start to shift out of growth stocks, which are your Magnificent Seven, and then move into defensive issues, utilities, and other, consumer staples and things like that. And even bonds, because when there's evidence that the economy is rolling over, that indicates weaker demand and future economic growth being weaker, which then translates into lower inflation and also lower demand for money. Borrowing. And so therefore interest rates tend to fall from that. That's natural forces that'll bring things down. So there's another example of where you can continue to see bonds moving lower, but all of a sudden, instead of that being, interest rates, the bond prices going up, but instead of that being bullish for stocks as it is now and has been, again, I showed you the tight correlation, there will come a point, I believe, where that is due to falling economic growth expectations and not just the Fed, taking his foot off the brakes to try to stop inflation. So, and that's where you can see stocks falling as well. Okay, regardless, we can trade them each on their own technicals. As of now, we hit T2 again. Just as I pointed out just recently, we hit T2, pullback as expected. That's why multiple targets are listed. T1, we gapped up above, it got taken out. So then resistance once taken out becomes support. So you can see we gapped above it, back tested that support level and hit T2, had a pullback. Now we're there again. If we can pop it, and that opens the door to T3 and T4, which I still favor. Shortly after putting this trade idea out there, I said for more typical swing and trend traders that don't want to game all the little zigs and zags off these 60-minute resistance and support levels. Gave you two targets that I think are likely for TLT, and that is T1 here at about 91.92, which should correlate with one of those 60-minute targets I gave you. And then this potential T2, I have a little asterisk there. I meant to put that because you have both price resistance at about 98.83 plus a downtrend line and the 200 days. So it's more of a zone up there. And that's quite a ways. If you look at it here, we're only about a third of the way there. So if I'm right on this, that would, should be net bullish for equity. So believe me, I cannot, nor have I yet ruled out that marginal new high scenario in the stock market. We came close. Again, I'm not going to digress in this video and go over and show you all the fangs, but remember, as I've covered many, many times in the past few weeks, even months, all those purple support levels have held on the big market leading Magnificent Seven FANG stocks and some other key sectors. Unless those go, and when they go, that's when we get the all-in kind of big leg down short in the market. And so right now it's basically a reflexive bounce off those support levels that were successfully defended, the positive divergences that were in place leading into earnings season with Apple and everything else. Maybe I'll get to those at the end of the video, and that way we'll keep it kind of concentrate on the stock market, because I consider analysis of Apple, Amazon, Microsoft, because of their significant weighting on the indexes. It's one and the same as covering the markets. But let me finish on treasuries while we're here. So there's TLT, and that's the typically the 30-year. They call it the 20 to 30-year Treasury bond ETF. And then the IEF is a 7 to 10 year, so it's really targeting the 10-year bond. And that one is at resistance. I mentioned that this morning to you, I believe. So that's why I think that breakout in QQQ is likely to fail. SPY's at resistance. So we could get a pullback, another pullback on Treasury bonds. And I'll tell you, you got to take that line out. We're going to look at a few more charts. Let's just spin right into those. Let's look at the yield itself. This is an important one. As I mentioned before, if I could only track one bond in relation, in my analysis with the stock market, whether I'm trading bonds or not, it would be the 10-year. Again, the 10-year is the most important one considered. It's what 30-year mortgages track. They track closer to the 10-year Treasury than they do the 30-year Treasury bond. So this is the primary uptrend line. And as I always say, if you have to squint to see if it's broken, then it's not. Give it the benefit of the doubt. So technically we are below it today. And again, this is how I have it drawn. There's a lot of reactions on it. You could pull it up a hair, down a hair. Let's just say this, that it's not yet broken. You can say it's broken if you want to say it's broken. But again, when we have a clear solid move down and a clear close below it, I will say that primary trend line, and that's an important trend line, guys. This is going back to the COVID lows, and it's not just an arbitrary trend line. There are a lot of reactions on there to validate it. Anybody, in my opinion, that is half skilled or more better in technical analysis is looking at this trend line. Remember, we also had, I don't know, some of these boards, it goes away. I'll show it I had it on the weekly. We had big negative divergence. So the charts indicate, here, let me jump over to the weekly. Here it is, the weekly. The charts indicate we could have a pretty sizable pullback. And again, sometimes I get so far ahead of myself. You probably don't remember this. You have to go back months, but I was calling for a new bull market and rates, higher yields, and still am longer term bullish. However, nothing goes straight up forever. As I said, I could see the potential that this is our primary secular bear market downtrend line for rates. This goes back to the early 80s right here. You can see the year breaks down here, 1981, Carter leaving office with a bunch of inflation, Reagan coming in, Volcker coming into the Fed and battling and getting inflation down under control. And that started the biggest secular bear market in rates, which is a bull market in bonds, bull market in stocks falling rates. And again, this is what kind of put the brakes on everything. The markets, and Powell was dismissive of it here until right about this point, and they realized that was a key level too. That's really, remember the NASDAQ peaked in November of 2021, and the rest of the markets, including the S&P, early 2022. So really, once we recovered that level, and you can see it was a strong move up, and then that's why we had the big drop in the markets. Okay, lots of lines, lots of busy stuff here. What do I have here on this chart? There's just so much, in my opinion. I have the primary downtrend line, which has been broken out. We've taken out previous highs. So again, the case I've been making and have made a long time, that this is a new early initial leg up in a new bull market in rates. Rates will be going up for years, if not decades, in my opinion, which is going to just give us a repeat of Japan's lost decade. And you look at the Nikkei, it's really 2 lost decades of 0 to negative returns in the Nikkei. But anyways, you can't trade off that. I mean, you can if you're, just want to get out of stocks and buy whatever else and stay out for the next decade. But we're gonna game the rallies. We're gonna try to game the rips and dips, especially those that look like they're gonna be double digits in the last weeks or even months. So where are we going here? So I had a wedge, a nice little purple downtrend line. There's 2 purple lines there I just covered over, and I've gone over all this before. There's the measured target for, again, you can see it on here. I'll zoom in nice and tight. And that's this smaller downtrend. It's under the primary downtrend. Positive, aka bullish divergence right there. That was a measured target back then, and so that came into play now, even though we went on to have that, unnatural, this is COVID right here, and this was extremely unnatural. That's when the Fed hit the nuclear button. These weren't natural market forces. That was extreme manipulation by the central banks to get rates down to that point, and then they just sprung back. So just want to mention that we hit that level. But more so recently, you had this negative divergence here, or you have it, I should say. We're just coming off it. Look, I mean, this is a monthly chart. That was last month's candle. We put in that divergent high. And again, sometimes the lines just kind of go away or disappear. Well, I'll fix that later. So I added that back. That's the divergence line. I think it was just chopped off on the top there. Sometimes if you move the scaling around, the kind of lines they disappear up on the top there. So that's a big, divergent high with a very well-defined trend line right there. And again, this minimum, that's the first target there, about 40.51, which means 4.5 or 4.05% in yields on the 10-year, coming down from where we were, about 5, and then potentially more than that. And I'll tell you what, I don't know if we're going that far down, but if we did, we could come all the way back down here. That would be a huge abatement in interest rates and yields, and still simply a breakout and a back test of the primary bull market trend line. Now, the thing is, guys, this should be, I put a little quotes here, should be net bullish for equities. And if that happens, unless it is because the market is melting down, and that is a combination of a flight to safety, meaning institutions are flocking to treasuries because the stock market's crashing. That's one scenario. The other could be that also the market's maybe going down in a more orderly fashion, but there's the economic indicators are rolling over at an accelerating rate, meaning jobless numbers are spiking up and all that good stuff. And then that just shows the odds of inflation or economic growth going up, or the odds are that they're falling, in other words, because again, you start to see the job market turn and calls for recession increase. That's going to imply future weakness for economic growth and inflation expectations, which could bring rates down. Okay, so it's not black and white, this stuff, and you can look back in history. Go back, take a chart of any bond or the yields that we're looking at here, and overlay them with the stock market. In the past, and you've probably heard this many times by now from me and others, for decades, or really a century or more, the old rule of thumb was the old 60-40 rule: 60% equities, 40% bonds. That was the gold standard portfolio, with the reason being every now and then the stock market has bear markets and corrections, and historically when stocks fall, bonds rally, and so it would help cushion the blows or offset the losses in your stock portfolio. But then something happened recently, and around the time of COVID, with all this artificial manipulation and rates, it's flipped over to a positive correlation. So 2022 will go down in the history books as the absolute worst year on record for the 60-40 model, where both stocks and bonds fell. And so what I'm trying to convey here is, don't get married to any one current correlation, because what's a positive correlation today may be a negative correlation or an uncorrelated a move between two asset classes. Primarily here we're talking about the stock market and bond market. So all right, so near term, where are we going? There's a weekly chart. Again, this to me looks like we're looking at a significant drop. That's this turn in yields that I've called for has only just begun, and is going to continue. So why aren't I super bullish on equities? Well, like I said, I kind of took a step back last week when I put that post out and told you, so I kind of closed out a lot of stuff. And on the equity side, it's still, bonds are still where the bulk of my longer term funds are right now. And I'm trying to just flip over to the 30-year. So I was just showing you the 10-year, and to take a look at the 30-year, you can see here, this is the way I have it drawn. The trend line isn't as well defined because we really only have a couple reactions there. But what does stand out to me is this big negative divergence right here. The last time we had negative divergence like this on the 30-year bond was right here. And that was the biggest drop in decades, if not history, right there for that point. And that's, again, yes, the Feds took rates down, but it is what it is. It came after a divergent high, just like you had positive, aka bullish divergence here at that low, and that gave us that move up, that gave us this little wedge. So basically, this was our last bearish rising wedge on the weekly. And when you're trading off the weekly, these are the trend. These are trades that are will signal trend changes. So a trend trader, someone that can take a position and typically hold that position for many months, if not years. And that's usually what it takes when you're on a weekly chart, when these trend changes occur. So that's that, guys. And if it changes, I'll let you know. But right now, it's hard to get very bearish on bonds. Remember, bonds going the other way than bond yields. But I'm also skeptical. There are, like I said, most importantly, let me just do it one more time. Although that's where I think things are going based on these big divergences and everything else. This isn't my clean board. It's more of a busy board. There's a clean board. There it is. There's your trend line. Although this breakdown in the 10-year looks imminent and likely, it hasn't yet happened. And if you've heard me say this once, you've heard me say this 1,000 times. Support is support until unless broken. So what we're looking at here is the daily chart, and we're still on that trend line on the daily, right? As we are, of course, on the weekly. It's the same trend line. I'm just tightening it up here. And so we could see a big head fake in bonds. The reason we went long recently was the 60-minute charts, the daily charts, and those divergences. But this rally could get sold into here. And I am not... I have not ruled out the fact that this bond trade could just turn around and go the other way and go see, in other words, another pop in yields, which would mean another leg down in bonds. TLT could come on down here. These divergences we have here on the daily chart may not play out. This is a weekly chart, by the way. I'm sorry. This is a weekly. I already gave you the daily. And, that's that. So this was an uptrend line here on the weekly. We took it out, and TLT is below that. So what I'm trying to say is I'm not getting married to any one scenario on the stock market or treasury bonds, and I may, at any point, and I'll let you know when I do, pull the plug on the the swing trend positions that I have on treasuries. My active trading account, I game them. You can go long, short. We hit T2 the other. That was T2 on TLT, but this is, I gave you the same time I gave you the setup for TLT, I gave you for futures trader ZB, and that's what I trade. There was a breakout. I mean, it was a beautiful breakout. That's a bullish falling wedge textbook. That was a hard one to pass on. So, but then the same time TLT hit that, remember, the targets aren't always going to align. Futures, you have a lot more candles. There's a lot more. The ZB, for those of you not familiar, these treasury bond futures trade just like stock futures, which is 20, it's not 24/7, it's literally 23/5.5, meaning they trade 23 hours a day. They shut down every day. I think it's the same on the hours on the treasury bond futures, but they do trade around the clock. So you're going to get to see a lot, things are happening at 2, 3, 4 in the morning. And so you're going to pick up different levels on the futures chart that you're not going to always see on the ETFs. But there it is. We're pushing up against that level. If we pop out, break out above there, this is a great level to also game another pullback. There was certainly a tradable pullback to be made off T3. And so I want to just wrap this up. We're not going to get to the other trade ideas other than the stock market and bonds right now. Let's just wrap this video up. It's gone long enough. Sorry for the brief pause there a minute ago. I was flipping charts trying to decide what to cover next. But like I said, you look down on the 15-minute charts, the 60. I showed you. I think I showed you. If I didn't, we have negative divergence for the first time in a while on the 60-minute chart, a QQQ here. This is a 15-minute chart. Very steep uptrend line, plenty of resistance. There's a 60-minute chart. Yep, you can see my little divergence lines. That's what I covered in the beginning of the video, I believe. If not, it was something else. But there they are. I'll show you. Small little negative divergences, almost exactly the same, slope on the line, and the length of the line right here is that divergent high, and so that one, gave us a drop of 8.5%. So sometimes these little divergent highs only give you a little pullback before the next leg up, and sometimes they give you much more. So this is an uptrend line that hasn't been checked in a while. So, and it comes in line with those other targets I gave you. Here, let me add it. This is the board I gave you before. So if you're looking, in case we get a deeper pullback, yeah, it's perfect. These are the 3 pullback targets I gave you yesterday, I believe, and they still hold true. 366.77, 364.51, and then 361.61. There's the uptrend line. So this is my preferred scenario. We come in, we hit that, we'll bounce along the way, a little zigs and zags, work our way down there, and that's where the bulls should step in and buy. But if they don't, then that's kind of other things are going on. And again, I will do this day in and day out. I'm cut back on my analysis because, again, I'm not trading as much right now, just kind of watching, seeing where the chips fall with the equity markets. And there's just not a lot of other things out there. I'm still short orange juice futures. In fact, we got a nice bounce today, a nice first bounce in a while. It was a great level to add to some, any shorts you have there if you're trading that one. Bitcoin, being patient with, it's not really rolling over hard yet, but I like that one. And that's about it. Other than that, let's just leave it at this for now. And again, overall I'm keeping it lighter than I have in a while with trades, and I'll continue to scour the charts. And my next video related to the stock market will probably be to do a sector update on the key sectors and the Magnificent 7 stocks. So I will probably get that one out to you tomorrow. I've got something I have to do today. So let me wrap it up here and get the video out to you. This has been Randy Finney with Right Side of the Chart. Have a great day.